Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Now, if you have over 1 crore rupees to invest and are wondering where to park that cash, then look no further, because this week's edition of Money, Money, Money is all about the world of alternate investing. Options that a high net worth individual can consider while making his or her investment choice. Joining me on the show this week is Vaibhav Sanghvi, the man who runs the largest hedge fund in the country, the Category 3 fund, which is the Ambit Alpha Fund. Now, this fund has recently crossed the 1,000 crore rupee mark in terms of assets under management. Also joining me to share the wealth planning perspective on AIFs is Feroz Aziz, Deputy CEO, Anand Rathi Private Wealth Management. Gentlemen, great to have you on the show. Thank you so much for taking out the time. So, Feroz, let me start with you first. When we are talking about alternate investing, we're talking about the super rich, the HNI and the HNI fraternity. Why should they look at alternate investments? I'm guessing the basic idea is to generate better return.
Correct. An alternative investment is for a person who has actually exhausted and utilized the other investment venues and wants to graduate to something which is exotic enough, and to have complex solutions of something which is a high return kind of a game. So that's precisely one reason why an investor would want to actually look at alternate. There are several other reasons as well, which could be trying to get something which is non-correlated to the market, because you have large exposures to equity, for example, then you have debt. But if you want to have something which is not correlated to either of these asset classes, then alternate could probably be something which is the only solution for you. So these are the two primary reasons. Returns and some degree of risk mitigation could be the right reason why somebody should ideally look at it.
So, Vaibhav, of course, you're running this massive fund, the Alpha Fund. What is the philosophy, or what is the thinking? What is it that you're looking to promise to the investor that he should look beyond traditional investment platforms and come to someone like you?
See, we all know the traditional risk matrix, and everybody knows that lower the risk, lower is the return, and higher the risk, higher is the return. The problem with that is basically while you invest into equities, the products, the equity products, do not take into account the behavioral aspect of an individual investing. And why do I say that is basically something like 2007, when the markets were booming, and that's the time we saw maximum amount of equity inflows coming into the markets.
Sure.
Everybody does say it's a great asset class, and it is indeed a great asset class, which gives you great compounding effect. But the problem is, the investor tends to come at the peak of the market and redeems at the bottom of the market, and that is what we have largely seen in empirically. What basically Ambit Alpha, our fund does, or probably what we aim to achieve, is to achieve those kind of returns. I'm not on a gross basis. I'm not saying on a net tax, net fees basis. On a gross basis, similar to those kind of thing, but at a much reduced standard deviation or volatility. And what is standard deviation volatility is basically the risk which you carry on investing into a product. So that's the basic objective of what we do.
It's interesting you say that, because when you think hedge funds, the instant thought that kind of comes to mind is high risk and then high return. Are you saying that's not necessarily the case?
That's absolutely not necessarily the case, purely because a hedge fund is just a word under which there are numerous strategies, and in numerous strategies there would be strategies which are of low risk, there would be high risk, and probably medium risk as well. We are at the lower end of the risk spectrum, but there would be products which would be beating equity markets. We are an absolute return fund, and there would be funds we would be relative return. A relative return on a comparative basis will carry a little higher risk.
Okay, fair enough. Feroz, it's important to understand the regulation and the categorization of alternate investment funds. So from what I know is that, of course, with the SEBI guidelines of 2012, now we have 3 separate categories, category 1, 2 and 3 AIFs. So if you could just quickly run us through how the different funds are placed.
See, I think, like you rightly pointed out, there are 3 categories. Generally, whenever there's a platform, there are more categories than an individual needs. And it gets confusing for an individual HNI investor too. So ideally, a category 1 is something which is a very seed fund and has some degree of CSR, corporate social responsibility kind of an objective. So most of the funds set up there.
A lot of the venture cap funds, I'm guessing, or the angel investing funds.
Angel investing funds, and they also have a wrapper of trying to get some degree of social social cause in it. So that's category 1. The category 2 and 3, which is more relevant from an individual's perspective. Category 2 would be where you actually invest in real estate and private equity funds, which actually deploys money for longer periods of time, because there's a minimum time frame of about 3 years. So time frame wise, it's 3 years. It gets listed. From a taxation perspective, you might just be able to get some degree of benefit. So that's the second difference.
Okay.
And the third is that the category of investment is private equity and real estate, more or less, because that's the minimum requirement of 3 years, which will help you invest in these two asset classes.
So, quick clarifications over here. When you mention real estate, we must keep in mind that we're not talking about real estate investment trusts, which is a totally different new category. It's a new vehicle altogether, which is yet to sort of take off in a very big manner.
Correct.
You mentioned taxation, so do elaborate on that for category 2.
See, category 2 has a pass-through taxation mechanism. Okay, pass-through is nothing but if the fund has a pass-through, then the taxation is passed to me and the fund doesn't pay the tax. But if the tax is paid at the investor level. So that's a pass-through mechanism. So it actually helps tax efficient instruments being packed there. So, but there's also a benefit of it getting listed. So if you actually did sell the units, because there's a listing, you can sell your units to somebody else. If you so did it, then you can get a capital gain out of it. So to answer your question, taxation wise, category 2 is better because it gets the tax gets passed on to you as an individual investor, and then you can plan your taxes much better.
So we'll get into category 3 and we'll talk more details. But just very quickly to understand the complexity levels within category 2, and we're talking real estate and private equity funds, the kind of leverage these funds can take, how complex are they? What is the understanding looking at the options in the market?
See, complexities can come from two different levels. One is the product construct, or second is the asset construct. Okay, if you're speaking about real estate is anyways a complex instrument because there's illiquidity. There's no valuation, so there could be two people on the same property might have different opinion of what they're priced at. So one set of complexities come out of the asset class you're buying.
In which case, if it's real estate, it has its own sort of
complexities.
Yeah.
So if you ask me, complexity on the product construct has come down significantly. Fees has become more transparent, and I think the investors' reporting mechanisms have become more wider. Notes have been given saying that this is how a manager needs to report. Unlike in the past, before this AIF category 2 was introduced, it was very haphazard. Somebody would value it every year, somebody would go as aggressive as valuing it every quarter. So transparency has gone up, and costs have come a little more transparent again on the cost side as well.
Okay.
But having said which, the asset it addresses, category 2, has been one of the most complex assets, private equity and real estate, because of its illiquid nature. So I would say complexity.
The opaqueness that kind of comes with this asset class. Both of these asset classes. All right, gentlemen. We'll take a break on that note, but when we come back, we're going to talk a lot more about category 3, which is where a lot of interesting options are coming up, of course, including the Ambit Fund itself. We'll be back after the break.